Right now, buyers with less than $15,000 are securing cash-flowing properties with 3% mortgages, while retail rates hover near 7%. The established playbook for real estate required 20% down on single-family homes in glamorous coastal cities, where the aesthetic hype often obscured the high barrier to entry. This chart shows how borrowing costs have moved since the previous decade. When a 7% interest rate crosses the yield line of a coastal market, it creates a frozen zone where monthly profit is mathematically impossible. This negative space represents a guaranteed monthly loss. Middle-class buyers are priced out of these traditional markets, unable to sustain the margin required for a standard mortgage. Structural arbitrage has replaced the residential purchase as the primary engine for capital growth. Capital is migrating into overlooked Rust Belt and Midwest cities, favoring dense infrastructure over sunny coastal trends. This migration is driven by a metric known as gross rental yield. The scale illustrates how yield functions. A $200,000 Heartland asset generating $2,000 in monthly rent tips the scale against an $800,000 property generating $3,000. In 2026, Midwestern yields of 8 to 11% are outperforming coastal markets by a factor of 4. Buffalo, New York has become a top-tier market by combining highly affordable multifamily inventory with steady, functional tenant demand. Identifying these high-yield zip codes is only half the equation. The actual challenge is bypassing the capital requirements of institutional banking. The traditional entry point for low-capital buyers is house hacking, purchasing a 2 to 4 unit multifamily building with a small down payment. FHA multifamily loans are currently bottlenecked by a specific institutional requirement, the 75% self-sufficiency test. This rule requires 3 out of 4 units to cover the entire monthly mortgage payment, inclusive of taxes and insurance. In a 7% interest environment, most Heartland deals fail this calculation. The alternative is the Fannie Mae 5% down conventional loan. This flowchart shows the procedural difference. While the FHA route hits a roadblock, the conventional Fannie Mae loan bypasses this test entirely, allowing for a standard approval. To access these specific terms, the buyer must reside in one unit as their primary residence. Navigating this underwriting blind spot transforms a rejected multifamily deal into a cash-flowing asset for a fraction of the standard down payment. Bypassing bank underwriting and 7% interest rates altogether is possible through Subject to real estate. In a Subject to transaction, the buyer acquires legal title to the property while leaving the seller's existing mortgage in place. Millions of mortgages were locked in at 3 to 4% between 2019 and 2022. Many of these are currently held by distressed or motivated sellers. Stepping into this existing debt avoids current market rates and the need for traditional credit underwriting. This ledger shows the impact of rate arbitrage. Paying an inherited 3% mortgage generates immediate monthly cash flow that a new 7% loan would otherwise consume. Strategic buyers in 2026 are prioritizing the acquisition of historical debt over the physical assets themselves. These creative structures demand conservative underwriting, particularly regarding the 50% operating expense rule and the risk of mortgage acceleration clauses. For those with zero starting capital, the Freddie Mac Home Possible program offers a path built on sweat equity. Under these specific guidelines, your documented physical renovation labor and materials can legally substitute for a traditional cash down payment. Speculative buying in expensive Sunbelt markets has been replaced by a model requiring capital efficiency in the heartland. The 2026 blueprint requires pairing high-yield Midwestern geography with precise financial structures, like Fannie Mae 5% terms or Subject to contracts. The path to middle-class wealth remains open in overlooked markets and creative contracts for those who prioritize structural efficiency over aesthetic trends.